Welcome back to the Deep Dive, where we unpack complex topics, get to the heart of what truly matters, and arm you with the essential knowledge you need. Get ready, because today we're diving into something fundamental, yet often sort of shrouded in mystery: how we actually put a price tag on a business, its assets, and even its future potential. It's the hidden engine behind so many financial headlines you see every day.
That's right. Today, our mission is to explore the fascinating world of financial valuation methods. You might see a stock price jump or plummet, or a massive company acquisition announced, or maybe even wonder how your own home's value is determined and think, how did they come up with that number? We're here to demystify the models, peel back the layers of assumptions, and reveal the crucial insights behind those figures, making every step clear and understandable for you.
All right, let's unpack this. We're starting with what we call absolute value models. Think of this as trying to find the true, intrinsic value of an asset, completely independent of what the market might be paying for similar things right now. It's about what it's inherently worth, based purely on what that asset itself is projected to generate over its lifetime, like looking at a company's DNA to understand its fundamental worth.
Exactly. These models aim to assign an intrinsic value to an asset by calculating the present value of its future cash flows. The core idea is simple, yet powerful. You estimate the cash flows an asset will generate over its life, whether that's dividends from a stock, interest payments from a bond, or, say, profits from a factory. And then we discount those estimated cash flows back to today's dollars. The rate we use for discounting is absolutely crucial here. It's based on current interest rates that reflect the level of risk associated with that particular asset and its projected cash flows, as well as the required return an investor would demand for taking on that risk. It's all about translating future economic benefits into a present-day equivalent value.
So a core concept for understanding those future cash flows, especially when they come in a predictable pattern, is the idea of an annuity. It sounds quite fancy, doesn't it? But really, it's just a series of equal payments spread out over a specific period of time. Think of it like a lottery payout spread over years, or maybe a fixed income stream you receive from a certain type of investment, like a pension.
That's a perfect way to put it. An annuity is precisely defined as a series of equal cash flows received over a number of periods. The traditional approach to asset valuation often uses the annuity present value formula. This formula essentially takes those uniform future cash flows and discounts them back to today using that specific rate of return, the same discount rate we just discussed, in order to determine their collective value in today's money. It helps you figure out, what's that whole stream of payments worth to me right now? We also distinguish between annuity due, where payments occur at the beginning of each period, and an ordinary annuity, where payments occur at the end.
Ah,
The intuitive difference is, well, if you get paid at the beginning of the month versus the end, that money is available for an extra few weeks, which gives it a tiny bit more value in today's terms. That small timing difference actually impacts the present value, even if the total payments are the same.
and if those payments last forever,
Yeah.
that's a perpetuity, a truly mind-bending concept. How does something that lasts indefinitely still have a finite value and valuation? It almost sounds like financial magic.
Well, it's not infinite if you consider the present value, thanks to the power of discounting. When those periodic cash flows from an annuity are expected to continue forever indefinitely, that's when it becomes a perpetuity or a perpetual annuity. The traditional annuity formula simplifies significantly in this specific infinite scenario because there's no known end date or duration. This specific method is incredibly useful, for example, when valuing certain types of securities, like preferred stock. Preferred stock is often designed to pay the same fixed dividend indefinitely into the future, making the perpetuity formula an ideal tool for estimating its value. The beauty of the perpetuity formula lies in its elegant simplicity. It allows us to quickly estimate value under these specific long-term assumptions.
So how does that formula look then for something that pays out forever, and what key pieces of information do you need to use it?
For a perpetuity, the value, or maybe the stock value per share, P, is simply the dividend, D, divided by the required return, R. So P equals D over R.
P equals D, dr.
It's surprisingly straightforward, isn't it? However, for this formula to work accurately, you must specifically assume that the dividend will never change, remaining absolutely constant in every period. Additionally, you must have a specified required return, which acts as your discount rate for those endless, unchanging cash flows. If either of those assumptions doesn't hold true, the model becomes, well, less applicable.
Let's put this into action with a quick example to make it concrete for our listener. What if we have our hypothetical Baker Corporation?
Okay, let's consider Baker Corporation. The facts are, Baker pays a constant annual dividend of $5 per share. An investor, let's call him Abel, wants to invest in Baker and earn a 20% return on their investment. We need to calculate the value of Baker's stock for Abel. Using our formula, P equals DR, we get P equals $5 divided by 20%, or 0.20. This calculates out to $25. So based on these very specific assumptions, a constant $5 dividend and Abel's desired 20% return, Abel should be willing to pay $25 for a share of Baker's stock to achieve their financial goal. This simple example clearly demonstrates how directly the desired return impacts the maximum price one would pay. If Abel wanted a higher return, they'd pay less. If they were content with less, they'd pay more.
But what if dividends aren't constant? I mean, in the real world, most companies aim to grow, right? The profits go up, hopefully dividends follow. That's where the Gordon growth model comes, and a true cornerstone for valuing growing companies, not just static ones. This sounds like a much more realistic scenario for publicly traded companies.
You've absolutely hit on a key point. The dividend discount model, or DDM, generally assumes that dividend payments are indeed the primary cash flows for an equity security. And the intrinsic value of a company's stock is the present value of those expected future dividends. When those dividends are assumed to grow at a constant rate into the foreseeable future, that's precisely when we apply the constant Gordon growth DDM. It essentially builds on the perpetuity concept, but cleverly layers in a growth component to reflect a dynamic business.
So how does that growth factor actually change the formula? Because growth isn't exactly a simple number to just plug in, is it?
You're right, it's a projection. The formula for the current price, P0, becomes D1 divided by R minus G. So P0 equals D1 over R minus G.
D1 RG, got it.
Here, D1 is crucial. It represents the dividend expected 1 year after the current period. So if you're only given today's dividend, D0, you'd calculate D1 as D0 multiplied by 1 plus G, where G is the constant growth rate.
Oh.
R, as before, is the required return, and G is the sustainable growth rate of the dividend. This growth rate is fundamental for capturing the dynamic, forward-looking nature of most businesses that aim to expand over time.
That sounds powerful, and I know it's widely used, but I imagine there are some important considerations or assumptions when using it. No model is perfect, after all.
Absolutely. This model, while elegant, has several critical assumptions you need to understand, and they are, quote, rigid. First, you must specify, or be able to calculate, the dividend 1 year beyond the year in which you are determining the price.
D1.
Right, D1. Second, you must include a required return, R, which acts as your discount rate for those growing cash flows. Third, and this is a big one, you must assume a constant growth rate of dividends that continues indefinitely into perpetuity.
Perpetuity again, that's a strong assumption.
It's a very strong assumption, yes. Few companies can maintain a perfectly constant growth rate forever. Fourth, the formula implies that the stock price itself will also grow at the same rate as the dividend in perpetuity. Another strong assumption about long-term stability and market efficiency. And fifth, and crucially, the required rate of return, R, must be greater than the dividend growth rate, G.
R has to be bigger than G.
Yes. If this relationship doesn't hold true, that is, if R is less than or equal to G, the formula will not work. It would result in a negative or undefined stock price, highlighting a significant mathematical and economic limitation. It basically means the model breaks down if growth outpaces the required return indefinitely.
You mentioned the required rate of return, R, which seems to be a common thread through these absolute valuation models. How do we figure that out? It seems like a very subjective input that could wildly swing a valuation.
You're absolutely right. It's a key input, and determining it isn't trivial. A popular and widely used method to determine the required return, for the DDM model, and indeed for many investment analyses, is the capital asset pricing model, or CAPM.
CAPM, okay, heard of that.
CAPM isn't just theory. It's the bedrock for how portfolio managers build diversified portfolios and how companies decide on their cost of capital for massive projects. It's the engine behind capital allocation decisions, often in the billions of dollars. The CAPM formula is R equals RS plus beta multiplied by the difference between ERM and RF.
RF plus beta ERM RF. Okay, let's break that.
Sure. R is the required rate of return on the specific stock you're valuing. RF is the risk-free rate of return, often approximated by the yield on a U.S. Treasury bond, basically what you can earn with almost no risk.
Got it.
Beta is where it gets interesting. Think of beta as a stock's swing factor, or its sensitivity to overall market movements. A beta of 1 means the stock tends to move in line with the broader market. A beta greater than 1 means it's more volatile, like a tech stock maybe, and a beta less than 1 means it's less volatile.
So higher beta, more risk?
Generally, yes. higher volatility. And ERM is the expected return on the market portfolio, like the anticipated return from the S&P 500. The term ERM, RF, is also known as the equity risk premium, or market risk premium. It represents the extra return investors demand for taking on the risk of investing in the stock market compared to a risk-free asset. So LAPM essentially tells you, based on its specific risk measured by beta, what kind of return an investment should deliver.
This is a lot of moving parts and powerful concepts. Let's revisit Baker Corporation and apply the Gordon growth model now with these new ideas in mind. Maybe see how growth changes things.
Excellent idea. Let's revisit Baker Corporation, now with growth. The facts are, Baker Corporation pays a current dividend per share of $5 per year. That's DA0, the dividend just paid.
D0 is $5.
And it's projected to grow at a constant rate of 4% per year. So G is 4%. Abel still wants to invest and earn a 20% return, which is our R, the required return.
R is 20%. Okay.
We are required to calculate the value of Baker's stock today. First, we need D1, the dividend 1 year from now. We calculate D1 as D0 multiplied by 1 plus G, so $5 times 1 plus 0.04, which equals $5.20.
$5.20 for next year's dividend.
Exactly. Now we apply the Gordon growth model. P0 equals D1 divided by RG. That's $5.20 divided by 0.20.04.
Okay, 0.20 minus 0.04 is 0.16.
Right, so $5.20 divided by 0.16, which calculates to $32.50.
$32.50.
So the intrinsic value of Baker stock today, considering its constant dividend growth, is $32.50. You can clearly see how factoring in that consistent growth significantly impacts the valuation compared to the zero growth perpetuity example we did earlier, where the value is only $25.
Right, a big jump.
Growth definitely adds value and makes a company more attractive.
No.
So these specific models we've discussed, annuities, perpetuities, the dividend discount model, are really just pieces of a much bigger puzzle, right? The grand discounted cash flow analysis umbrella. It sounds like this is the ultimate goal when trying to figure out absolute value, maybe the gold standard for intrinsic valuation.
Precisely. DCF analysis is indeed the overarching approach that attempts to determine the intrinsic or true value of an equity security by calculating the present value of all its expected future cash flows. It's a fundamental framework that financial professionals rely on heavily for everything from valuing public companies to private equity deals. When an analyst applies DCF analysis, they generally follow a systematic set of steps. And this isn't just plugging numbers into a spreadsheet. It's building a detailed story of a company's future, often with significant uncertainties and challenges.
What are those steps? How do you actually do a DCF analysis in practice, given how much goes into it? Well, the first step is to choose an appropriate model. This isn't a one-size-fits-all situation. It could be a dividend discount model, like the Gordon growth model we just discussed, which uses the stock's expected dividends as the relevant cash flows. Or, more commonly for operating businesses, it could be free cash flow models.
To be cash flow, right.
These are popular because they focus on the actual cash flow left after a firm meets its operating and investment obligations, cash that can truly be distributed to investors. This includes free cash flow to the firm, FCFF, which is cash available to all capital providers, or free cash flow to equity, FCFE, which is cash specifically available to equity holders. Another option is residual income models, which look at the income left over after satisfying investors' required return, focusing on the economic profit a company generates above its cost of capital.
Okay, so first pick the right type of cash flow model. What's next?
The second step, and arguably the most challenging and subjective, is to forecast the security's cash flows based on whichever of these model approaches you've chosen. This involves making informed projections about future revenue growth, operating expenses, capital expenditures, working capital needs, all sorts of things.
That sounds like a lot of guesswork.
It's educated guesswork, yes. It's not just plugging in historical averages. It's about making assumptions on the competitive landscape, technological shifts, economic cycles, and even potential management biases. You're essentially building a detailed financial roadmap for the next 5-10 years, and then making a critical assumption about what happens beyond that explicit forecast period into what we call the terminal value, which often accounts for a huge portion of the total value.
Your terminal value, right?
The value way out in the future.
Exactly. Third, you select a discount rate methodology. As we discussed, CAPM is very popular and robust for estimating the required return on equity. But sometimes analysts also use a weighted average cost of capital, or WACC, especially if they're valuing the entire firm rather than just the equity. WACC considers debt, too.
Yes, the WACC considers the cost of both debt and equity, weighted by their proportion in the company's capital structure. The fourth step is to actually estimate that discount rate using your chosen methodology and then apply it to your appropriate DCF model. And finally, the fifth step, calculate the equity security's intrinsic value based on your discounted cash flows and then compare it to its current market value. This final comparison is key as it tells us if the asset is potentially undervalued, fairly valued, or overvalued in the market, guiding investment decisions. It's a comprehensive process that requires careful thought, robust data, and a significant amount of judgment.
Okay, so we've talked about intrinsic value, what something should be worth based on its internal financials and future projections, but what about what it's worth compared to other things? That's where relative valuation comes in, right? It feels much more like what we see in the news, like when analysts compare companies in the same industry. It's almost like comparing houses in a neighborhood to get a sense of a fair price.
Absolutely. If absolute value is like looking at a company's DNA to understand its intrinsic worth, then relative value is like comparing it to its peers in the family album. Relative valuation models work by using the value of comparable stocks to determine the value of similar ones. Instead of focusing solely on internal cash flows to derive an intrinsic value, they rely on price multiples, which are ratios of a stock's market price to another measure of its fundamental value per share.
Like PE?
Exactly, like PE. Investors use these multiples to quickly determine if a stock appears undervalued, fairly valued, or overvalued compared to its peers, industry averages, or even its own historical averages. It's all about context and benchmarks, providing quick snapshots for comparison.
Everyone talks about the PE ratio. Why is it so popular? It seems like such a quick way to gauge a company, but sometimes a high PE makes people nervous and other times excited.
The PE ratio is indeed the most widely used multiple when valuing equity securities. Its rationale is straightforward. Earnings are considered a fundamental driver of investment value, directly influencing stock prices more than almost any other single factor. It's universally used by the investment community because it provides a simple, intuitive snapshot of how much investors are willing to pay per dollar of a company's earnings. And importantly, empirical research has even shown that changes in a company's PE ratio are tied to its long-run stock performance, suggesting it has some predictive power. However, while PE is a quick snapshot, it's crucial to remember its blind spots. A high PE could mean a company is significantly overvalued, or it could mean investors are betting on explosive future growth, especially for tech or biotech companies that reinvest heavily.
Right.
Conversely, a very low PE might signal an overlooked bargain, or it could indicate a company facing serious structural headwinds or declining profits. It's always about context.
So how do you calculate it, and then how do you actually use it to value a company in a practical sense?
The PE ratio is simply the stock price, P0, divided by the expected earnings per share, E1, 1 year out. This is known as the forward PE because it relies on future earnings projections.
E0 over E1.
Correct. Once you have a PE ratio perhaps from a comparable company in the same industry, an industry average, or even a historical average for the company itself, you can then multiply that PE ratio by anticipated future earnings, E1, to estimate a current stock price,
Yeah.
P0. It's a simple algebraic rearrangement. However, it's worth noting that this method specifically requires that earnings be greater than zero, as you can't divide by zero or use negative earnings meaningful in this ratio, which is why it might not work for early-stage companies that aren't yet profitable.
Let's use our favorite, Baker Corporation, to illustrate the TE ratio.
Okay, for Baker Corporation with PE, assume Baker Corporation has a current year earnings per share of $1.50 and anticipates earnings per share in the coming year of $2. That $2 is our E1.
E1 is $2.
If the market average PE ratio for similar companies is 7.5x, meaning investors are paying 7.5 times earnings, we need to calculate the expected value of Baker shares. The solution is straightforward. P0 yields P0E1 E1, which is 7.5 multiplied by $2.
So 7.5 times 2, $15.
Exactly, $15. The meaning here is that applying the PE ratio of 7.5x implies that the current stock price should be 7.5 times the anticipated earnings per share of $2, leading to an expected price of $15. It's a quick, direct way to arrive at a valuation, assuming you have that relevant PE multiple from a comparable.
You mentioned forward PE. Is there another kind, and why is that distinction important for investors trying to make sense of a company's financials?
This is a crucial distinction indeed. The numerator, the stock price, is always clear. For publicly traded companies, you can just look it up. However, the denominator, earnings, can use past earnings or expected future earnings. When past earnings are used, such as earnings for the past 4 quarters or trailing 12-month EPS, the ratio calculated is the trailing PE.
Trailing, okay, based on the past.
Right. The formula for that is P0 divided by E0, where E0 is the EPS for the past year. This is preferred when a company's forecasted earnings are unavailable or unreliable, giving you a snapshot of past performance. Conversely, when expected earnings for the next year, E1, are used in the denominator, the ratio is the forward PE.
Looking ahead.
Exactly. This is generally preferred when a company's historical earnings are not representative of its future earnings, perhaps due to a significant change in its business model, a new product launch, or maybe unusual one-time events in the past. It's about choosing the earnings figure that best reflects the company's future prospects, and investors are generally more interested in the future than the past.
Sometimes a PE doesn't tell the whole story, especially for those high-growth companies. What if a company has a high PE but is growing super fast? Does that change how we interpret the PE? Does a high PE always mean it's overvalued, or is there another dimension to consider? That's where the PEG ratio steps in, right?
Exactly. The PEG ratio is a more refined measure that explicitly shows the effect of earnings growth on a company's PE, assuming a linear relationship between the two. It attempts to normalize the PE ratio by accounting for growth. Generally, stocks with lower PEG ratios are considered more attractive to investors than those with higher ones.
Lower is better.
Yes, because for the same PE, a company with a higher growth rate will have a lower PEG, implying you're getting more growth per unit of PE. It's a way to identify potentially undervalued growth stocks where a high PE might be justified by even higher growth. It's sort of a quick filter for growth at a reasonable price, or JARP investors.
How is it calculated, and how do you use it for valuation purposes?
The PEG ratio is calculated as the PE ratio, specifically the forward PE, POE1, divided by G, where G is the growth rate expressed as a whole number.
A whole number, so 4% growth is G4.
Correct. G would be 4, not 0.04. This scaling factor helps keep the numbers manageable and intuitive. You can also use the PEG ratio to calculate the stock price by rearranging the formula. P0 equals PEG multiplied by E1 and then multiplied by G. It basically gives you the price based on how much growth you're buying.
Let's try Baker Corporation again, but this time with the PEG ratio.
Okay, for Baker Corporation with PEG, the facts are Baker wants to use the PEG ratio to estimate the price of its stock. The company's PEG ratio is 2.5x. Its current earnings per share, EPS, is $5, and the growth rate for earnings is anticipated to be 4%.
PEG is 2.5, current EPS $5, growth 4%. Got it.
We need to calculate the current price of Baker stock. First, we calculate the expected EPS for the next year, E1. E1 equals $5 multiplied by 1.04, which gives us $5.20.
E1 is $5.20, same as before.
Right. Now we apply the valuation formula. P0 equals PEG E1G. So P0 equals 2.5 multiplied by $5.20 multiplied by 4. Remember, G is the whole number.
2.5 times 5 by 20 times 4. Let's see, that's $72.
$52, exactly. So using the PEG ratio, Baker's stock price is estimated at $52. It demonstrates how different multiples with different underlying assumptions and ways of factoring in growth can lead to varying valuations for the same company. It highlights the art as much as the science in valuation, doesn't it?
What about companies that aren't profitable yet or have really volatile earnings, maybe because they're cyclical or in early growth stages? You can't use PE or maybe even PEG easily then. Is there a multiple for them where earnings aren't the primary focus?
Yes, that's where the price-to-sales PS ratio becomes incredibly useful. Similar to the PE ratio, it estimates current start price, but it focuses on revenue rather than earnings.
Focuses on the top line.
Exactly. Its rationale is strong. Sales are generally less subject to manipulation than earnings or book values because they are top-line figures before many accounting adjustments and discretionary expenses. Crucially, sales are always positive, making this multiple usable even when EPS is negative or zero, which is common for startups or high-growth companies in their early unprofitable stages.
Makes sense.
Plus, it's often less volatile than the PE ratio because it doesn't include the effects of financial and operating leverage, which can amplify earnings swings. Empirical studies suggest it's particularly appropriate for valuing mature or cyclical companies, as well as those in early growth phases where profitability is still distant. You calculate it as stock price, P0, divided by expected sales in 1 year, S1, and you can value equity as P0 equals PS multiplied by S1.
And cash flow, that's what truly keeps a business going, right? Not just accounting earnings that might be influenced by non-cash items like depreciation or amortization. Is there a multiple that focuses directly on the real money flowing through the business?
Absolutely. The price-to-cash flow PCF ratio is also widely used for valuation precisely for the reasons you mentioned. It emphasizes that cash flow is harder for companies to manipulate than reported earnings, as it represents the actual money coming in and out of the business.
Harder to sudge the cash.
Pretty much, yes. It tends to be a more stable measure than PE, providing a less volatile view of a company's financial health, as it strips out accounting estimates like depreciation and amortization. Furthermore, research indicates a positive relationship between changes in a company's PCF ratios over time and its long-term stock returns, highlighting its relevance for investors focused on sustainable performance and a company's ability to generate actual cash. You calculate it as stock price, P0, divided by expected cash flow in 1 year, CF1, and can value equity as P0 multiplied by CF1.
Moving to the balance sheet, what assets does the company actually own, net of liabilities? The book value. How does that factor into valuation? It feels like a very different way to look at a company's worth, more about its foundational assets, maybe.
The price-to-book PB ratio is another key multiple used by analysts, and it uniquely focuses on the balance sheet rather than the income statement of cash flow falls. The rationale for its use is that a firm's book value of common equity, which is essentially assets minus liabilities and preferred stock, is generally more stable than earnings per share.
More stable than earnings.
Okay. This stability is especially valuable when a firm's EPS might be extremely high or low in a given period due to unusual events or cyclical industry factors. Since PB is usually positive, it's particularly useful when a firm's EPS is negative or zero, making it applicable to a broader range of companies, including those in distress or with highly volatile earnings. Research also indicates that the PB ratio can help explain a firm's average stock returns over the long run, suggesting it captures a fundamental aspect of the value of the underlying assets. You calculate the PB ratio as stock price, P0, divided by book value of common equity today, B00, and you can value equity as P0 equals PB multiplied by B0.
Let's go through an example that ties a couple of these relative valuation methods together, like bold incorporation. This should help solidify how these numbers are actually extracted and used from financial statements.
This is a great way to see it in action. So an analyst has market and financial data for Bolden Corporation's most recent year-end. The stock price is $18, and there are 10,000 common shares outstanding.
18 price, 10 million shares.
Okay. The financial data includes total assets, liabilities, preferred stock, common stock, $25, additional paid-in capital, $45, retained earnings, $50, total stockholders' equity, and cash flow from operations of $25 million. The analyst project's operating cash flow will increase 20% in the upcoming year. We need to calculate both the PB and PCF multiples for Bolden.
All right, let's start with price to book, PD.
Okay, first for the PB multiple. 1. Determine book value of common equity. This is the sum of common stock, additional paid-in capital, and retained earnings. So $25 million plus $45 million plus $50 million equals $120 million. That's the total equity for common shareholders.
$120 million total book value.
Right. 2. Determine book value of common equity per share. Divide that total book value by the shares outstanding. $120 million divided by 10 million shares gives us $12 per share. This is what each share theoretically owns in net assets.
$12 book value per share.
Exactly. 3. Calculate the PB multiple. This is P0 divided by B0. So $18 the current stock price divided by $12 the book value per share, resulting in a PB of 1.5x.
1.5 times book value.
Got it. Now, for the PCF multiple, based on the analyst's operating cash flow forecast. 1. Determine the firm's expected cash flow per share. Current cash flow from operations is $25 million. It's projected to increase 20%. So next year's cash flow, CF1, will be 25 million times 1.2, which is $30 million.
$30 million expected cash flow.
Correct. 2. Then cash flow per share, CF1 SFH, is $30 million divided by 10 million shares, equaling $3 per share.
$3 cash flow per share next year.
Yes. 3. Calculate the PCF multiple. This is PA0 divided by CF1, so $18 stock price divided by $3 cash flow per share, which gives us 6.0x.
6 times cash flow. Okay, so we've calculated both PB and PCF for Bolden. So these multiples rely heavily on projections, future earnings, future cash flows, future sales. What are the key things we're implicitly assuming when we use them, and what kind of influence does management behavior have on these numbers? It sounds like there's a lot of room for interpretation here.
That's an excellent point. Price multiple ratios, like any financial model, come with similar underlying assumption requirements that are often heavily influenced by management behaviors and strategic decisions. These assumptions include projections of future earnings, future cash flows, and future sales. We also have to assume a future growth rate for these metrics and whether that growth is sustainable. And finally, we're making an assumption about the duration of these sales, earnings, or cash flow trends. Are they sustainable long-term, or will they hit a wall due to competition or market saturation? Understanding these helps you critically evaluate the ratios you see, because if those underlying assumptions are off, the resulting valuation can be wildly misleading. It truly highlights that these are tools, and their accuracy depends heavily on the quality of the inputs, the realism of the assumptions, and frankly, the integrity of the management making those projections.
Yeah, that makes sense. It's why analysts spend so much time scrutinizing management's guidance, I guess. Okay, so far, we focused on valuing a company's overall market presence through its stock and what its fundamental financial statements imply. But savvy investors also look at other financial instruments. So, moving beyond direct stock ownership, what about options? They sound like choices, but in finance, they're precise contracts with their own unique and often complex valuation methods. How do these fit into the valuation world?
Indeed, an option is a contract that gives the owner or holder the right, but importantly, not the obligation to either buy, that's a call option, or sell, that's a put option, a specific stock or some other underlying asset at a predetermined price called the strike price within a stated period of time.
The right, not the obligation. Key difference.
Exactly. That's what gives them their value. You only exercise if it's profitable. We differentiate between two main styles. American-style options, which can be exercised at any time prior to their expiration date, giving the holder maximum flexibility, and European-style options, which can be exercised only at the expiration or maturity date of the option, limiting the exercise window. This distinction is crucial for valuation, as the added flexibility of American options usually makes them, well, slightly more valuable.
How do you put a price on these choices? It seems incredibly complex to factor in time, the strike price, the underlying stocks movements, and even interest rates. It sounds like financial alchemy.
It can seem that way, but there are established models that do precisely that. The first, and perhaps most famous we should mention, is the Black-Scholes model.
Black skulls, right. Heard that name.
It's a commonly used method for option valuation, particularly useful for valuing European-style options, where the exercise is only at maturity. While the actual calculation is extremely intricate and involves advanced mathematics far beyond what we need to delve into here, it's important to have a high-level understanding of its core concepts and inputs. Accountants, for example, often utilize this model when valuing stock options for share-based payments, which are a common form of employee compensation, especially in tech.
So what are the key inputs that Black Scholes needs to calculate an option's value? What are the factors that feed into that complex equation?
The Black-Scholes model requires several key inputs to determine an option's price. These are 1. The current price of the underlying stock. That's the market price of the asset the option is based on. 2. The option's exercise or strike price, the price at which you could buy or sell. 3. The risk-free interest rate, to account for the time value of money. 4. The current time remaining until the option's expiration. Time decay is a big factor. And finally, a measure of risk, often referred to as volatility. Volatility captures how much the underlying stock's price is expected to fluctuate.
More fluctuation, higher option value.
Generally, yes. Higher volatility usually means a higher option value because there's a greater chance of the stock moving dramatically in a favorable direction for the option holder. All these factors are carefully weighed in the formula.
Okay, so Black Scholes is one major model. You mentioned another one.
Yes, the binomial model, also known as the Cox-Ross-Rubenstein model. This is another significant option pricing model, and it's quite different from Black-Scholes. Unlike Black-Scholes, which values an option at a single point in time, the binomial model considers the underlying security's price movement over a period of time, mapping out possible price paths.
Multiple paths. How does that work?
It breaks the time down into steps. This multi-period perspective makes it particularly useful for valuing American-style options, precisely because they can be exercised at any point during their life. It allows for dynamic decisions about when to exercise.
And what are the assumptions for the binomial model? How does it simplify something so inherently unpredictable as stock price movements?
Well, the binomial model operates on specific assumptions to simplify the problem. It assumes a perfectly efficient stock market, and importantly, it assumes that the underlying securities price will only move either up or down at specific discrete points in time called nodes.
Only up or down at each step, like a tree branch.
Exactly. So at each step, the stock can only go to one of two places. The result is a visual representation, a tree diagram, that illustrates all the possible price paths the stock could take, and consequently, the possible option values at each of these nodes across different time steps. This tree allows for the modeling of early exercise decisions, which is crucial for valuing American options, making it quite flexible in practice.
Moving beyond stocks and options, companies also issue debt like bonds. How do we value those? It feels like it should be simpler, given they usually have fixed payments, but I know interest rates can throw a wrench into that.
You're right, they involve more fixed and predictable payments than stocks, but the valuation still fundamentally requires present value calculations. The value of a bond is simply equal to the present value of its future cash flows. These cash flows consist of two main components: regular interest payments, known as coupons, which are typically paid periodically, like annually or semi-annually.
The coupon payments.
Yes, and the final principal payment, also called the face or par value, which is received at the bond's maturity. These cash flows are discounted using interest rates that are appropriate for the level of risk associated with that particular bond and its issuer. This might be a single interest rate, or more complex models might use multiple rates across the yield curve depending on the bond's maturity and structure.
And what determines if a bond is issued at its face value or at a discount or even a premium? That always seems to confuse people.
That comes down to the relationship between the bond's fixed coupon rate and the prevailing market interest rates for comparable bonds at the time of issuance. It's all about supply and demand for yield. Bonds paying a fixed coupon rate equal to the market rate for similar bonds will be issued at their par or face value. They offer a competitive return, so investors pay face value.
Makes sense.
If a bond's coupon rate at issuance is less than the market rate, investors will demand a lower price to compensate for the lower interest payments they'll receive compared to new bonds. So the bond will be issued at a discount to its par value.
You pay less because you get less interest.
Exactly. Conversely, if the coupon rate is more than the market rate, investors are willing to pay more for the attractive higher interest payments. So the bond will be issued at a premium.
You pay more to get that higher interest.
Right. It's a direct reflection of whether the bond's promised interest payments are competitive with what's available in the market. And importantly, as market interest rates change over time, the market value of the bond will also change. For fixed-rate bonds, there's a critical inverse relationship. When market interest rates rise, the market value of the bond falls, and vice versa.
So interest rate risk is key for bonds. Can you walk us through an example of valuing a debt instrument so we can see how those predictable cash flows are discounted back to today's value?
Certainly. Let's imagine a $1,000 face value bond maturing in 3 years that pays annual interest of 4%. This means it pays $40 in interest each year.
$1,000 face, 3 years, 4% coupon, okay?
We need to calculate the bond's price if the market rate at the time of issuance is 5%.
Market rate is 5% higher than the 4% coupon, so it should be at a discount.
Correct. It will be issued at a discount. We need to discount each future cash flow back to today using that 5% market rate. For the year-end payment, $40 interest, discounted at 5% for 1 year. $40 divided by 1.05 to the power of 1 equals $38.10.
$38.10.
For the year 2 payment, another $40 interest, discounted at 5% for 2 years. $40 divided by 1.05 squared equals $36.28.
$36.28.
For the year 3 payment. This year, we get $40 interest PSUS to the $1,000 principal repayment, so $1,000 total, discounted at 5% for 3 years. $1,040 divided by 1.05 cubed equals $898.39.
$898.39.
To find the total value of the bond today, we sum these present values. $38.10 plus $36.28 plus $898.39 equals $972.77.
$972.77. Less than the $1,000 face value, just as expected.
Exactly. This is the bond's price today, reflecting that discount because its coupon rate is below the current market rate.
Okay, so we've valued companies and their financial instruments like land, buildings, equipment. How do we value those, which are so physical and concrete? It seems like it should be more straightforward since you can literally touch them.
That's an incredibly important area, often referred to collectively as property, plant, and equipment, or PP&E. These fixed assets provide the foundational infrastructure a company needs to support its operations, from factories to offices, trucks, machines. While GAAP, generally accepted accounting principles, typically dictates how PP&E is reported on the balance sheet, usually at historical cost, less accumulated depreciation. There are indeed specific methods used to determine their actual economic or market value, which can differ significantly from their book value.
Right, book value isn't always market value, especially for old assets.
Exactly. A factory built 50 years ago might have a very low book value, but its land could be worth a fortune today.
So what are these different methods for valuing tangible assets, and how do they reflect the different reasons someone might want to know their value, like insurance versus selling?
Good point. We have several approaches, each with its own utility and context. First, the cost method. This is perhaps the simplest approach. The value is primarily based on the original cost paid to acquire them. Adjustments are commonly made for depreciation, which reduces the asset's value over time to reflect its current utility, wear and tear, and economic obsolescence. This reflects its book value.
Okay, historical cost minus depreciation.
Second, the market value method. This method is perhaps the most intuitive. It requires that similar assets be available and actively traded in the marketplace to find a comparable value. It's like finding comps for a house.
Finding comparable.
All right, there are two common iterations of this. One, the replacement cost method. This determines what it would cost to replace the valued asset today with a new one that performs the same function. So what would a new, modern equivalent cost? Two, the net realizable value method. This considers the price at which the asset could be sold in the marketplace today, but importantly, this is reduced by any costs specifically associated with selling the asset, like brokerage fees, transport, or disposal costs. It's what you'd actually pocket.
So replacement cost versus what you'd get if you sold it, net of costs. Can you give us an example of that market value method, specifically how those two iterations might lead to different numbers?
Certainly. Consider a company assessing the value of specialized manufacturing equipment. Using the market value method, they determined it would cost $6.2 million today to replace all of its existing equipment with new equivalent stuff. That's the replacement cost.
$6.2 million to replace.
Alternatively, they also determined that selling their existing equipment in the secondary market today would generate $5.9 million after accounting for all selling and disposal costs. That's the net realizable value.
$5.9 million if they sold it.
Right. So depending on the purpose, planning to replace it or planning to sell it, either of these values, $6.02 or $5.09, could be used as a reasonable proxy for the asset's market value. It highlights how the purpose of the valuation drives the choice of method.
Okay, cost method, market method. What else?
The third method is the appraisal method. Under this approach, a professional, independent appraiser determines the value. The key here is finding an appraiser with specialized knowledge and experience with a specific type of asset, machinery, real estate, whatever it is. Their expertise provides a credible third-party assessment, particularly useful for unique assets where market comparables are scarce.
Get an expert opinion. Makes sense for unique stuff.
And finally, the liquidation value. This represents the amount the company would receive if the asset had to be sold today, often under distressed or time-constrained conditions.
Like a fire sale.
Exactly. It's often considered a fire sale value, reflecting a quick, forced disposal. This method typically gives the lowest valuation, representing a floor or minimum value, often relevant during bankruptcies or urgent asset disposals.
This is where it gets really fascinating to me. Patents, trademarks, intellectual property, copyrights, things you can't touch but are incredibly valuable and often define a company's competitive edge. In today's modern world, a company's biggest asset might be its brand or its software. Valuing these intangibles seems more critical and probably harder than valuing factories. How do we put a price on those?
It's a critical and often more complex area, absolutely. Intangible assets, by definition, lack physical form, yet they provide probable future economic benefits. These include patents, trademarks, intellectual property like software, formulas, copyrights, all sorts of things. Valuing them often requires different, more creative approaches than tangible assets, precisely because of their non-physical nature, unique characteristics, and the difficulty in finding direct comparables. It's truly where the art and science of valuation collide.
So what are the primary pathways to valuing these unseen but often incredibly powerful assets?
We have three main approaches. The first is the market approach. This approach uses actual arm's-length transactions, meaning sales, transfers, or licenses between independent parties of similar assets in similar markets as a reference point.
Again, looking for comparables, but for intangibles this time. That sounds like it could be hard to find perfect comparisons for something as unique as a specific patent or a secret formula. Are there significant challenges with this method?
You're absolutely right. That's its main challenge. While this is often a preferred approach due to its reliance on direct market evidence, the unique nature of individual intangible assets and the relative infrequency of their trading can present significant hurdles. No two patents are exactly alike, and the market for them isn't as liquid or transparent as, say, the stock market. You might find some comparable licenses or sales, but rarely a perfect match, which requires significant judgment to adjust for differences.
Can you illustrate with an example of trying to value a patent using the market approach, given those challenges?
Sure. Imagine a company wants to monetize a patent. They look at recent comparable patent sales and find four. Sale 1, $18.5 million. Sale 2, $16.2 million. Sale 3, $16.8 million. And sale 4, $15.1 million.
Okay. A range from 15.1 millers to $18.05.
Right. The company would then typically assign a value within this range. They might use the median value of, say, $16.5 million, or more likely, they would identify the transaction that most closely matches their own patent's nature, tech maturity, and potential, and use that as a benchmark, maybe with some adjustments. Still involves significant judgment.
Okay. Market approach. What's the second one?
The second approach is the income approach. Using this approach, the future expected cash flows generated directly by the intangible asset over its estimated useful life are discounted back to their present value.
Like a DCF, but specifically for the cash flows from the intangible.
Exactly. If a patent saves you costs, those savings are the cash flows. If a trademark lets you charge more, that premium is the cash flow. The discount rates used here are crucial and must reflect the risks specifically associated with that income stream asset-specific risk, industry risk, market risk. It's about quantifying the economic benefit the intangible is expected to deliver.
Let's use an example for the income approach to see how those future benefits are converted to today's value.
Okay, consider Eagle Road Enterprises. They own a patent expected to generate $4 million each year for the next 10 years by lowering production costs.
$4 million a year for 10 years.
Using a discount rate of 5.5% and a pre-calculated discounting factor for that stream of payments over 10 years, which is 7.5376, the patent is worth $30.15 million today.
Where'd you get that?
You multiply the annual income, $4 million, by the discounting factor, 7.5376, to arrive at $30.15 million. This illustrates how future earnings from the intangible are converted into a present-day value.
Market income. What's the third approach for intangibles?
The third approach is the cost approach. This is typically used when there are no similar assets or transactions to reference, so the market approach is out, and no reliable estimates of future income, so the income approach is out. The cost approach basically asks, what would it cost to replace or reproduce this intangible asset today? This can be relevant for things like software or internally developed IP.
So what kinds of costs go into that? It sounds like it could be a broad category.
It is. When using the cost approach, iterations can involve either replacement cost, the cost to create a similar asset with comparable utility, or reproduction cost, the cost to reproduce the exact same asset, including original specs. The costs included are comprehensive, materials, labor, like developer salaries, overhead, legal fees, patent filing, trademark registration, development costs, production costs, and importantly, opportunity costs.
Opportunity costs.
Yes, the value of the next best alternative foregone by investing resources in creating this intangible instead of something else. It's the sum of all efforts and resources required to bring that intangible into existence today, including what you gave up to make it.
Can you give us some example of how this cost approach would work, perhaps for a copyright, like software code?
Absolutely. Let's look at Alpine Inc., valuing the copyrights for a unique software module. Using today as the valuation date, Alpine determines the reproduction costs. Labor, $15,000. Materials, $9,000. Overhead, $11,000. Legal fees, $22,000. Development costs, $16,000. Production costs, $13,000. And opportunity costs, $26,000.
Okay, adding all those up.
Summing these up, the total cost and thus the value derived from this cost approach is $112,000. It quantifies the investment required to recreate that intangible today.
It sounds like a lot of these valuations involve estimations and judgments, especially when we talk about projections or the value of unique assets. How do accounting departments handle that in their official financial statements? Seems like there's room for interpretation and probably scrutiny.
You've hit on a crucial point. Many financial statement line items are indeed valued using accounting estimates, introducing a significant layer of professional judgment. It's not just hard numbers. For instance, accounts receivable is shown net of an allowance for uncollectible accounts. That's an estimate of bad debts.
Right.
Inventory is reported at the loader of cost or market net realizable value, involving estimates for obsolescence. Fixed assets are offset by accumulated depreciation, an estimate based on useful life assumptions. And contingent liabilities, like for lawsuits, are based on the best estimate of probable future losses. These are all areas where management judgment is essential.
What kind of data and expertise go into making a reliable accounting estimate given how much judgment is involved? Where do these estimates come from?
Management must consider various data and factors. Historical information is key. GAAP requires using past data for things like bad debt allowances or justifying depreciation methods. Market information is crucial for inventory valuation, lower of cost or market, and assessing obsolescence. Expected usage drives depreciation methods. How much will we use this machine? And for highly specialized areas, like litigation losses, they often rely on estimates from experts, like attorneys or actuaries. It's a blend of internal history, external markets, and expert input.
And how are these estimates checked and reviewed? It seems like there's potential for variation or even bias. This is where auditors come in, right?
You're right to highlight the scrutiny. Estimates must be supported by robust documentation showing assumptions and calculations. Transparency is key. Management has a responsibility to regularly review and formally approve material estimates. Furthermore, external auditors closely scrutinize these assumptions and supporting documents. They're looking for reasonableness and challenge anything that seems off or contradicted by other evidence.
So there's an independent check.
Exactly. It adds a critical layer of assurance for investors.
This all ties into a broader, increasingly important concept in financial reporting: fair value. What exactly does that mean, and why has it become so significant that there's an entire standardized framework for it? It's not just a casual term, is it?
No, not at all. Fair value is a very specific accounting term precisely defined under U.S. GAAP. It's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants in the principal or most advantageous market at the measurement date under current market conditions.
Wow. Okay, that's a mouthful. Let's break that down.
It is specific. It's not about historical cost, but what it's worth in the market today. It's about a hypothetical objective exit price, what you'd get if you sold it now in a normal market. It's become significant because it aims to provide more relevant, timely information by reflecting current market realities.
You used specific terms: orderly transaction, market participants. What does orderly transaction really imply? Not a fire sale.
Exactly. It's fundamental. An orderly transaction is not a forced liquidation. It means the asset or liability was exposed to the market for a reasonable period before the measurement date, allowing for usual marketing activities. It implies a normal, unhurried market process. It explicitly cannot be a forced transaction, which would likely result in a lower, distorted price.
And market participants, who are they?
These are the hypothetical buyers and sellers whose perspectives inform the fair value. They are defined as being independent, not related parties, arm's length, knowledgeable. They understand the asset liability, able to transact. They have the financial capacity, and willing to transact, not compelled, acting in their own economic best interest. It's about creating a theoretical arm's length market with rational, informed participants.
So if an asset could trade on multiple markets, say a stock listed in New York and London, which one dictates fair value? You mentioned principal and most advantageous markets.
That's a critical distinction. The principal market is the one with the greatest volume or level of activity for that specific asset or liability.
The busiest market.
Right. If there is a principal market, the price in that market is the fair value measurement, even if another market offers a better price. The entity must also have access to this market. It reflects the idea that the most active market provides the most reliable price.
And if there's no principal market?
Then, and only then, you look for the most advantageous market. This is the market with the best price for the asset, maximizes sale price, or liability, minimizes transfer payment, after considering transaction costs.
Transaction costs matter here.
They matter only to determine which market is most advantageous. But crucially, they are not included in the final fair value measurement itself. The fair value is the quoted price in that chosen market, not the net amount. It's a subtle but important point.
Can you walk us through an example of figuring out the most advantageous market using those transaction costs?
Sure. Let's say Gertie Inc. holds Foxyco stock, trading in New York and London. Gertie can access both. At measurement date, New York. Quoted price $52. Transaction cost $6. Net $46. London. Quoted price $50. Transaction cost $2. Net $48.
Okay. NY has higher price but higher costs. London, lower price, lower costs.
Here are the scenarios. If New York is the principal market, fair value is the NY quoted price, $52. Ignore transaction costs for the final value. If London is the principal market, fair value is the London quoted price, $50. Ignore transaction costs if there is no principal market. We look for the most advantageous market after costs. London's net price, $48, is better than New York's $46, so London is most advantageous. The fair value is then London's quoted price, which is $50. Again, transaction costs don't reduce the final fair value measurement, they just help pick the market.
What about non-financial assets like land? Does fair value consider how it could be used, not just how it's currently used? This sounds like it could uncover hidden value.
Yes, for non-financial assets specifically, fair value considers the market participant's ability to generate benefits by using the asset in its highest and best use, or by selling it to someone who would.
Highest and best use. Okay.
This recognizes that a property's value isn't just its current use, but its optimal potential. There's a presumption that current use is highest and best, unless market factors clearly suggest a different use would maximize value. The highest and best use might involve using it with other assets or standalone. It's about finding the usage that creates the most value, even if that means changing things.
So this highest and best use only applies to tangible, non-financial assets, not stocks or bonds. Why the distinction?
Correct. It's not relevant for financial assets or liabilities. Why? Because items like stocks or bonds don't have alternative physical uses that affect their value. Their fair value doesn't depend on use within a group of other assets like a factory building might. Their value comes from contracts or market characteristics, cash flows, risk, not potential physical deployment.
Can you give us an example of highest and best use for land, maybe currently used as a factory?
Sure, a company acquires land with a factory on it. But similar nearby sites were recently developed for residential retail, generating higher returns. Highest and best use is determined by comparing 1. The value of the land as currently developed for industrial use, land plus building value, maybe less debt. 2. Against the value of the land as a vacant site for residential or retail use. This considers potential revenue minus the cost of tearing down the factory, cleanup costs, and development uncertainty. Fair value will be based on whichever use results in the highest value, regardless of its current state. It forces a look at maximum economic potential.
So there's a whole standardized framework for fair value with specific rules on how to measure it and what inputs to use. This sounds like a comprehensive system for consistency.
It is indeed a robust framework under U.S. GAAP. It has two main components. It outlines the valuation techniques allowed, and it establishes a hierarchy of the inputs that should be prioritized. This structure guides preparers toward the most reliable, observable inputs, enhancing comparability and transparency. It tries to bring more objectivity to subjective areas.
What are these valuation techniques that entities can use?
Entities can use one or a combination of these three approaches. 1. The market approach uses prices from market transactions involving identical or comparable assets liabilities, finding real-world comparables. 2. The income approach converts future amounts, cash flows, earnings, into a single discounted present amount, like a DCF for fair value. 3. The cost approach uses current replacement cost to measure fair value based on the idea that value shouldn't exceed the cost to replace it. The guidance is always to use the appropriate technique and maximize observable inputs while minimizing unobservable ones.
And then there's a hierarchy for the inputs within those techniques. That sounds like a way to prioritize the most trustworthy data.
Precisely. The hierarchy of inputs prioritizes inputs based on reliability and observability. Level 1 is highest priority, level 3 lowest. The level assigned to a fair value measurement is determined by the lowest level input that is significant to that measurement. So if one significant input is level 3, the whole thing is level 3.
Ouch. So one weak link defines the whole chain.
In terms of classification, yes. The goal is always to maximize observable inputs, level 1 and 2, and minimize unobservable ones, level 3.
So level 1 inputs are the best. What makes them the gold standard?
Yes, level 1 are top tier. These are quoted prices in active markets for identical assets or liabilities that the entity can access. Active markets means frequent transactions providing current pricing. Think NYSE stocks. Level 1 inputs are most reliable because they represent actual, observable market transactions for the exact item. They're objective and must be used when available.
What about level 2 inputs? Still observable, but not as direct.
Correct. Level 2 are inputs other than quoted market prices, level 1, that are still directly or indirectly observable. Examples include quoted prices for similar assets in active markets, quoted prices for identical or similar assets in markets that are not active. Other observable inputs like interest rates, yield curves, credit spreads, inputs derived from or corroborated by observable market data. Think of valuing a bond not actively traded using yield curves and credit spreads, or valuing a house using comps.
And finally, level 3 inputs. These sound like a last resort, most subjective.
They are. Level 3 inputs are unobservable inputs. They reflect the reporting entity's own assumptions about what market participants would use.
The company's own best guess?
Essentially, yes, based on the best available information, but without direct market evidence. This might include internal data or proprietary models. Level 3 should only be used when Level 1 or 2 inputs aren't available without undue cost and effort. They introduce the most subjectivity and require significant disclosure in financial statements so users understand the limitations.
Wow, we've covered so much. From calculating a stock's worth based on its dividends, to understanding how the market prices a patent, or even land based on its highest potential use. It's
Huh.
clear that financial valuation is far more than just picking a number out of thin air. What stands out to you from this whole deep dive?
What's truly fascinating here is the sheer breadth of tools available, from precise mathematical models for securities and debt to more nuanced approaches for tangible and intangible assets, all culminating in this standardized fair value framework. It underscores that while there are rules, the process often blends objective, hard data with crucial estimations and professional judgment, reflecting the inherent complexities and uncertainties of the real economy. It's never just a single, simple number, is it? It's a carefully constructed conclusion based on assumptions, each with strengths and limitations. A blend of art and science, really.
So, what does this all mean for you? The next time you hear a company's stock price or read about a multi-million dollar acquisition of a patent or a massive real estate deal, consider the layers of valuation that went into that number. It's not just a simple figure. It's a carefully constructed estimate based on a blend of art and science and a deep understanding of future cash flows, market dynamics, risk, and the specific characteristics of the asset being valued. How might understanding these valuation methods change how you perceive market headlines or even influence your own personal financial decisions, whether you're investing, assessing a business opportunity, or just trying to understand the economic world around you? Think about that for a bit.